Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, August 2nd, 2024. It's 10:50 a.m. Eastern Time. As I'm starting the video, and I wanted to get this one out to you quick, I just fired off this post as quick as I can, let you know my thoughts. I eliminated or canceled these additional targets for now on the VIX. That is the final target. That means final target is where I think, at least for the time being, the end of the run is there. I do think the VIX will go higher in the coming weeks here. I just think there's a decent chance we're going to bounce here. So I just actually, as I told you, I'm closed mind. I have VIX futures, but I even reversed those and turned around and shorted. Now, we could still melt down, and if so, the VIX then explodes, and it could run up, towards that. Remember, these were targets based on an ETF. I'm a futures trader. The VIX, as I've said many times, you can't trade the VIX, the spot VIX. That is, it is an index. It's not hypothetical, but it's you can only trade futures on the VIX, which I like to do. Options on those futures if you're an options trader, or ETNs and ETFs that track the futures, but they have expenses. Over time, you're going to lose money. I always say you got to be hit and run. So I've been making the case. The VIX has looked attractive, and then when we had those the sell signals in the market a couple weeks back, a month or so ago, with the bearish engulfing candles, everything else, it was just one of my favorite trades, and I got out to you via VIXY, as you know, which is for those of you that most of you trade ETFs, ETNs. And it was right here in the wedge. I said you could take it here and or add on a break of the pop above the wedge, and so from where that was a 54% gain. Now, can we go higher? Oh, absolutely. We hit that fourth target to the button. If the markets just melt down from here, they're down pretty heavy today. It's not what I'd call a meltdown, just another strong day. A crash is possible. So look, one option, guys, if you think that's going to happen, and as I've been saying, if the odds now are higher than they've been in many, many years, even back in 2020, guys, even back in 2022, when we were in that last bear market, sell-off mode. All the conditions now are much higher than they were then. Closest we come is COVID and then the financial crisis. So what I'm saying is, boom, we can blast on through there. So I will not stay short the VIX if that's the case. So let me go over the levels and tell you why. Okay, well, first of all, this was a target. So, the other option, guys, if you think that's going to happen, you got in this thing, you're happy with your 50+% gain, you're looking for more, because as I've showed you, the VIX, that's run of the mill. When it wants to run, it can really run. You can just simply raise your stops to protect profits. It's volatile. You can't run a 2% trailing stop loss on the VIX, or you're going to stop out in the noise. I tell you that right now. Anything that you're looking at, any security where you're looking at a trade potential of 50% or more, it speaks to the volatility right there. So that's just kind of a takeaway, trading 101, something I'd like to pass on, these little lessons I've learned over the years. Natural gas, don't run a 1% trailing stop. Don't even bother. You're going to get clipped out in the noise. You're shooting for 20, 30%, trend, swing trades over a period of just a couple weeks, sometimes days. That's a volatile security. So you need to use wider stops. Take your position size down smaller. That's rule 101. I call it beta adjusted position size. And that allows you to allow yourself a wider stop without taking a dollar loss that exceeds your comfort level. Okay, so let's get to everything else now. So I started the morning on ES. Let's just go there and I'll kind of take it from there. So we are now a little bit below that level, and that's to be noted. And that's a break of a pretty good support. Remember, it was a target here listed as, we were short, but we weren't short the S&P. We were short the NASDAQ based on these same sell signals, these wedge trendline breaks and back tests here. And then we had the bearish engulfing candle. But remember, the NASDAQ peaked back here well before July 10th. Long before the S&P, and I made very clear, short the NASDAQ, not the S&P, not even the small caps at that time. It was the NASDAQ 100, and it vastly outperformed to the downside. But these were, additional sell signals on the S&P that followed, and then I started giving you the targets, including this initial swing target, highlighted covering shorts there. Thursday before last, I think it was, highlighted long again here. 2 bounce targets we hit. At the time we hit this level, and I was outlining a bounce, I gave you this target, said after we bounce, this is my next downside target. So that's been hit and now cut through. And you see, this is the character of this market. I had a couple levels yesterday for active traders that buyers, quote unquote, should have stepped in and didn't. And that kind of shows me the nature of this market. It's that POR, what I've talked about repeatedly, a term I came up with many years ago, point of recognition, where the masses, out there, the general public, and even the bobbleheads on Wall Street that are, again, it's my background, but, it's more of a financial advisor, stockbroker. I'm talking about the guys, they march out on CNBC and running portfolios and all that and telling you why everything's going to go up and AI, the economy doesn't matter, it's strong, jobs are strong, AI is here to stay, NVIDIA has more orders they can follow. But when the paradigm shift hits, that point of recognition where the masses realize all these things I and some others have been talking about for a while that do matter and will eventually matter. It's that whole melanoma analogy I've been giving you. You can ignore that mole on your skin for a while. It's changing colors, the irregular borders around the edges, crusty, raised, and you just keep ignoring it, and that's fine until it's not fine, until the day you go to the doctor and he says you got in situ melanoma. It's penetrated the dermis, and now you've got stage 4 cancer running throughout your body. That's what this market's been like. That's what I've been talking about. And so when that happens, you start to get these swift sell-offs. Now, okay, that's all the bearish talk. That's what I've been talking about. We just undercut that level, but let me show you some reasons why we may bounce, why I decided to close out the VIX trade, and even believe it or not, on this, despite this breakdown, just like recently, we broke down, and then I think there's a good chance we'll come in and reverse, but we need to do it really soon, and it needs to happen today, I believe. So I'm going to move this divergence line here because it's still intact. 60-minute chart. Remember, this is just the futures on a 60-minute chart. Let's look at a couple things here. Let's look at QQQ. So on QQQ, going back to, I think it was June 26th, way back here before we even topped, I gave you a market top range. That range was based on a myriad of factors: technical experience, technical analysis experience, it's Fibonacci projections, Fibonacci retracement levels. And so we came within, that was before we got in there, came within 1.5% of my market top range. I then adjusted the fibs to account for the fact we were just a little shy. Again, right smack, 2/3 up, 3/4 up in the way of the range. And so where I'm going is my first target, again, laid out before we even hit the top, calling for the top, and then now we hit that first target. We are under it by a slight amount. Again, relative speaking, QQQ is a 450-point security. So, it's, every 5 points is not that much. We're talking 1% or so. And we're there now. And you can see just below it is that, and again, I adjusted the fibs to come in right off the highs. We're at the 23.6% key Fibonacci retracement level, which is just below the price support that I had there at 449.70, right? And which is still price support. Now, on the bearish side, we did take out the trend line. Now, that's net bearish unless that trend line gets. And look, guys, nothing's changed. We're going here. I have a high degree of confidence. Nothing's set in stone. This only further solidifies it. It's just a matter of how we're going to get there. We're going to melt down, and if we do, we're going to go to the 200s. I need to, and I haven't done it. The other day, I added a week or so ago this extra support level here, 431.80-ish. And it comes right in the 200 days, which I've been calling for weeks or even months now, calling for a move back down to the 200 days, telling you it's going to be a pretty healthy correction because we got pretty far away from them, right? So we're going to the 200s. I have little doubt about that. Again, are we going to get there today, tomorrow? Maybe. And this is when you do it in these kind of meltdown modes, you can get there pretty quick. So that's very, very much a possibility. However, we're still in close enough proximity to this price support level. We're right on that 23.6 fib level there. So if the buyers are going to step in and give us a back test of this trend line, which would be an objective shorting level for a ride down to the 200s, it's going to happen. It needs to happen now. It doesn't have to, but it really ideally should happen about now. Okay, so to summarize, we have QQQ at support. Remember, T1 was way back when I laid them out here in late June before we even topped out. So the first target would be the primary uptrend line and or the intersecting 449.70 as support, plus 23.6% Fibonacci retracement from the high. And again, that's what I typed. You can see there, created back on 617. Just when I move it, that's the only edit I've had to it. Every time you drag it, changes the updated date. So unchanged, and that's where we are. So from before we topped, that's where I figured we'd go before we had the first significant reaction. And again, we had one off the trend lines. We gamed it. It was a big, biggest pop, short-term rally in months. We milked it from the lows to the highs, back in short. But now we're at support again. Now here's the thing. Maybe again, this is a trend line break. It's certainly, the trend line break in itself opens the door and increases the odds we're going to go to the 200s. I just kind of coin toss, do we get a reaction here or not? I'm going to show you the other levels. We're going to go over the market leading FANGs. We're going to go over the semis. And then by the time I get the video out, it's either going to be time dated, we'll just have continued on down through there, melted down, continued down. And we may hit this level today. And then it's going to be one of those big 5% down days or not. Let me see how much more we have to go actually. We grab the bottom of the candles, roughly, about another 3% or so, close to it. All right, so again, I think they'll probably step in and buy it here, and that's why I put a hard close on that VIX futures and actually reversed mine myself. Went from long to short. I think they'll pull back, and the premium will melt off if we bounce here. Let's go to SPY. SPY, we're a little bit shy of my first target. Remember, I gave you comparable targets at the end of June, also a market top range. We hit the middle of that market top range in the S&P, and we're coming very close. So we have a little downside to really good support. It's this trend line, which I've used a little. I've let this violation of that trend line there. It's the best trend line I could draw. It's not a super duper trend line. It's just I put a heavier weighting on the price resistance. Plus, it's also the 23. No, you know what? I need to tweak those fibs. I'm going to do it right now. Remember, I had the fibs were used to help calculate, looking at SPY and QQQ, where the market might peak. QQQ, I've already adjusted them. So, oh yeah, it still comes in right there anyways, perfectly at 525. So that shows you basically in the S&P 500, we've got before really good support, we've got about another 0.65%. So again, a kind of a market crash, for lack of a better word, sudden swift meltdown is possible. Higher odds than I've seen in years, but right now I think they probably come in and buy it one more time. And at least the RR isn't great. You can bet on that. You can hold out. Look, if you're short and you want to hold out for that scenario, just set your stops, trail them down. If we blast on through there and we head right down to the 200s and in the S&P 500 and that next target, it's possible. We don't have to have a reaction on the initial tag of all my targets, especially when we have a lot of hot air that's been built up in the market. So we could blast on down to T2, hit the 200 days and T2 in the S&P 500, and then the VIX will explode. And it'll probably hit those higher targets that I gave you before. Let me just cover a few boards. So on the 60-minute chart, interesting, we still have positive potential. Remember, guys, I use a lot of made-up terms, and one of those is confirmed versus potential divergence. This is the primary trend line on the S&P 500. It goes way back, and we clearly broke down and back tested it here, moving lower. We're fresh off the sell signal. We had that little wedge break, got you in early there. One last hurrah off the trend line, breakdown, back test. If I extended that trend line, you'd see a back test there. And now we have positive divergence. But positive divergence can get plowed over, just like bearish divergences in a strong uptrend. And we saw plenty of that get plowed over on the upside, meaning they just don't play out, or they start to play out. And right as they start to play out for a pullback, they get the buyers step in. So we could see that, and the sellers could take it down. And this is just a 60-minute chart. This is rough. I'd go off the daily on the support levels, but there is a potential there for a reversal. Let me go to the Qs. QQQ 60. We also have nice, strong, positive divergence. So, and this is what I usually like to see for a tradable, trend tradable bounce. And so I'm going to tell you right now, besides the technicals, everything I'm going over, I've got a few market leading stocks I want to hit on. I want to hit on the semis, show you some things, semis at the 200 days. And the narrative, if you're wondering with all this bearishness going on, everything I've been talking about is come to fruition now, where the employment's starting to clearly roll over. It was, if you don't know, it was the jobs number today that friggin' just missed by a mile. Yesterday it was ISM, missed by a mile. So we're seeing it now, and it's that turn's coming quick, right? Before it was a little trend, and they were dismissive, and on the contrary, they meaning the majority of market pundits were saying, oh no, it's good, it's bullish, because we rally on bad news because we're going to get a Fed rate hike. Well, let me tell you what happened today and yesterday. The ISM missed by a mile. And remember, Powell just spoke last on Wednesday at 2:30, his dog and pony show after the FOMC announcement. And he repeatedly said, we've not made any decisions for a rate cut in September, not at all. We're going to be data dependent, blah, 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 blah. We all know we're getting a rate cut in September. It is now solidified. I can tell you it's solidified because I'm watching the euro spike, the dollar plunge. Rate. I didn't even pull the Fed fund futures. I don't need to. I've done this long enough to tell you they've now locked in a September rate cut, right? So the narrative is going to be, if we have a huge rally by the end of today and they reverse and rally off here and maybe even close this 3% deficit. Right now, the Qs are down 3%. It will be because of that. The bobbleheads, they'll be marching out. They'll bring out the cheerleading squad on TV and tell you that the rate lock's locked in and everything. Now we're good to go. We're going to get that rate cut. Fed's here to save the day. Well, you and I all know, and I've said it many times, pull a federal funds futures historical chart without fail. After a rate hike, rates plateau or start to be cut right away. They plateau and then are cut, and then invariably the recession follows, right? So a rate hike is not bullish, but I know that. Smart people know that. Those that have studied history have been through these cycles, but most people don't. And the people on coming out on Bloomberg and CNBC telling you to buy because of it, they either do know and they're just pumping their book trying to get out of their longs, or they really just don't. And there's a lot. I've learned that a long time ago. I saw it during the financial crisis. Most of them missed it by a mile, didn't see it coming, and it was as clear as my hand in front of my face. And to some others, what was happening in the housing market and the financial markets, and so it's just it's been long enough now. You got a new, fresh batch of pimple-faced kids coming out of business school and working in that industry that read about but didn't live through those previous cycles or the dot-com bubble especially. Okay, so that is what could cause a near-term bounce, but we need to hold these levels, or everything else I've been talking about for months will cause just this waterfall down, take us to the next targets, which again, T2 is going to be here, the 200 days. And as I told you before we were still going up and calling for a move down to the 200s. I said it's quite likely to see us have a waterfall sell-off by the time we start to get there. I said exactly what would happen, that this sell-off would start out, start to build momentum. You get a counter trend route, and at some point in it, you get that waterfall sell-off, the point of recognition. Then you can slice on through there and bounce. Thing is, I think today, like I said, they'll probably come in and buy this up. It's my guess. And if we go on down through that, I'll just flip back. No big deal. I can flip back to short. I've got stops below, not far below. Just picked it up. I just reversed here, so I've got some stops a little bit below the lows on the VIX futures, or the highs. I'm sorry, short of the VIX futures, and I'm going to play it by ear for the Qs, but I probably won't, in Qs, I won't let it go much below. So I think this is it. It's got to be. If we don't stop here, then we go on down. So I think it's at the very least, guys, it's an objective level to cover shorts and reverse, or like I keep talking to the non-active trader, the swing trader and trend trader holding out for the prize, my longer term targets. You should have been in here, here. There were multiple entry points, and if you are, just lower your stops to protect profit. Right now, where? Well, I think over yesterday's high is a great level. We should not pop yesterday's highs at this point, so that would be a great stop for those holding out for the longer term targets. And active traders, do what you want, but like I'm making the case for bounce. Let me get to everything else. NQ, this is a 60-minute chart. 18,490 is support right there, positive divergence, and then I have the daily chart too, which we undercut that target. We came very close to T5, and close enough that may account for a hit there. And so again, on here on the daily, I'd still maintain these other targets. Again, I'm talking a matter of, do we bounce one more time, another bounce before we go down there, or not? I think the odds are decent, not super high, but decent. Let me show you everything else. Let me start out with the market leaders, right? Apple, the only one green today. Of the big, the top 10 in the NASDAQ 100. Apple's fresh off reporting. We all know what happened to Intel. There's a great example of, how low stocks can go. Microsoft, look at that, 200-day. I've been calling this one down to the 200s for a while. All these stocks and the rest. Look, most of them haven't hit. I can tell you right now, I'd have a much higher degree of confidence if the vast majority of the market leading stocks and the indexes, SPY and or QQQ, were hitting their 200 days, right? Because that's where the algos step in and buy. However, they're likely to step in and buy Microsoft at the 200. Why do you say that, Randy? Well, you can go back in time and you can see Microsoft is even better when you look on a weekly chart, put up the 40 period moving averages, and you can see bull trends. They buy pullbacks to it. There was a bear market in COVID, but then when we recovered it, you stay above the 200. Once you break it, it's resistance. You short rallies back to the 200s, and then when you're above it, you buy pullbacks. That's the red and blue line, simple and exponential. And there we are. First time since right here, at the last time we hit the 200s, if you bought Microsoft, you made 54% if you held it to the highs. If you took it back here when it took back the 200s after being below them in COVID and held it, again, playing the game high to low, 125%. If you shorted it when it broke the 200s here, or if you missed that breakdown and then you waited for the back test, which we did, we shorted the market there and there, we came to each counter trend bounce back then you made 30% on the downside. So now that's one. Unfortunately, there's a lot of other market leaders that haven't yet hit the 200, so therefore my confidence isn't super high yet. We gotta go down a little more, hit the next targets, and then I might be interested in taking a more aggressive position with a little bit wider stops. So there's Microsoft at the 200, just above that 397 support. NVIDIA still coming. This is a daily 60-minute chart. I still have it at that 102.57 the other day. That's where I posted covering NVIDIA and then reshorting back up here. That needs to go. That's now support. Remember, it was this gap. So NVIDIA is retesting the top of gap support. If it goes down to my next target, which I still maintain, but I think we can get another bounce first for the reason I'm about to show you too with the semis. Alphabet, GOGL, Class A, at that, this is gap support right here and testing that level, 162.73. Now, still longer term bearish, break down and back test there. It's going lower. It's going to go to its 200s, but I think it can bounce first. If the market bounces, if they come in. Amazon's a good one. Amazon gap down today, took out the primary uptrend line. Again, that trend line comes off the January 2023 lows, undercut the 200 days. But look, it hit that 160.12. That's a level I've had on this target I've had on here for a while. It was the bottom of this gap right here. And in reverse so far, and they will probably park it on. This is my experience, guys. When we start going down, as I've been calling for the big market leaders and the indexes to test the 200s, what's going to happen? Invariably, some are going to get there first. Some are going to overshoot. Those that overshoot will typically come back and after a brief overshoot and park on the 200s or test them or even recover them, while the other ones then later on will fall. So either way, Amazon's leading the pack here for the big market leaders. Undercut today, down one of the biggest down days in a while. Great buy point today at 160, and it'll probably come back up here and park back on that trend line by the end of the week, or maybe even today. That's my guess. Meta's kind of big post earnings pop, faded that, and still above support. Nothing much to say. It hasn't got to the 200 yet. Broadcom, look at this. This is by the way the seventh largest holding in the Nasdaq 100, seventh largest company, Broadcom, and that one has pulled back to my primary uptrend line off the October 2022 lows. Very good support level, a level I think ultimately goes, but they're going to buy it most likely first. We haven't tested that trend line since back here. This is the first test of that trend line and really good price support. So hence another reason. If this was just some obscure semiconductor on semi or some little semiconductor, yeah, I'd say, you know what, but this is a big one, and so they're likely to buy it. Let me just see what Tesla's doing now. Tesla's nothing. So let me talk now SOX. SOX Semiconductor ETF. This is top heavy in NVIDIA, but look, boom, first test of the 200s. Slight undercut, but that's what it does. Tested the 200s here with a slight undercut. Tested it here, after being below. When it was below, back test. Hopefully you can see the 200s on my chart. It's just a beautiful level, and whether it works or not, this is where traders come in and buy. So this is the first pullback on SOX, on the semiconductor sector ETF, since October. And if you bought that one in October, you made 72%. Are you going to make 72% now? I doubt it. I'm just looking for a reflexive bounce, that's all. And as I'm trying to make the case here, a couple other semi ETFs, XSD, a little bit below, but again, that's the nature of these volatile semis. They tend to, this one undercuts a little more. It has a different basket of holdings. SMH is another one. Right now, perfect test of the 200, bounced off it today. The 200-day exponential moving average, a red line, hit them both there. The exponential and simple. Exponential was below them here, and they kept selling rallies back into the 200s. So, all right, I don't want to beat a dead horse, but that's what it is, guys. I'm showing you. And then at the end of the day, despite the recent price action, like I said, my guess is the narrative, if we do bounce and have a pretty hard reversal today, it'll be that euphoria that, okay, yay, we finally got shitty enough economic data to seal the deal. The Fed's going to have to cut in September. They have no choice. Here, I'll show you how this works. Oh, by the way, on that VIX, when I fired it off to you, I hadn't even attached, I forgot to upload the second chart. So if you go to the post, you wouldn't have got it in your email and the email alert, but there it is. So that was the post I got out to you as quick as possible. I added the chart right after. But what I wanted to show you here is federal fund. You'd go like this. CBOE Fed funds futures. I'm just typing in the search bar. Fed watch. This is it. You go right here. Again, I hadn't checked it today. Just accept. You can have my cookies. I don't care. Target rate. Here we go. Now we have a 74% probability of a rate hike at the next meeting. Oh, wow. Oh, look at that. No. Okay. Again, I just checked this today. I haven't, I don't turn the TV on unless it's, I want to watch like a Fed announcement or anything big. Current target rate's 5.25 to 5.50. So they're banking on now a 0.5%, 73% chance of a 0.5% cut. Wow. And, 26%, almost 27% chance of a quarter point cut. So not only is a quarter point baked in the cake now of a 50, it's not baked in the cake, but the odds favor a 0.5% rate cut. So this is what you call a hard turn. This is what I've been talking about. They've been, again, I just don't get it. That's clear, the evidence, if you look at the right and know how to interpret the economic data, the indicators have been rolling over, and those that haven't, that have been kind of distorted, the big one is the jobs. And that's what the Fed quotes most. And I'm going off what Powell says. And again, if you listen to smart people and read up on this, much smarter than me, that fundamental analysis, you read about the convoluted birth-death model that the government uses to calculate the employment data. It's insane. So what happens again? It's that whole cancer thing. Like I said, ignore the lump on your breast for as long as you want to. If you keep ignoring it, it's going to get to that point where suddenly, when you realize, oh, I'm having pain, you go into your doctor, it's too late. A lot of damage has been done, and that's what this market has done, ignoring what I've seen a clear trend of fundamentals and excessiveness and over hype. With AI and what it's going to mean to these businesses and Meta, any company just using the words AI, and even if it's not really AI, that's just obviously been bothering me, that companies can just come out with the word AI in their quarterly earnings report, or say this is some new AI related thing, and it's really not. It's just another iteration of technology, just like a lot of these well, anyways, let me not get off on too much of a tangent. So that's it. So where am I going? Where am I going with this? Again, this will be now the narrative. Oh yeah, we're going to have a big rate cut. The market's going to love it, and so the market, they'll buy it on that. They always have, by the way. You get this, and there's euphoria when you get the first rate cut, or when it's kind of baked in the cake like this. So we're probably going to step in and buy it on that reason. Then the reality will set in later. The smartest of the smart people will know that this is only coming. The Fed's only going to do this or this because they finally, is behind the curve as they always are, see that the writing is on the wall and that a recession is pretty much inevitable at that point. Okay, and where to? If we do reverse today and we're still just off the lows, so this video I'm gonna wrap it here, get out to you. I think we could probably close the day green or close to green. That's going to be 3%, because remember we're at 3% at the lows today. So, and there's today's gap. Oh no, there's the top of the gap right there. So to close the day green, you're talking about a a little north of a 3% rally, and that's just if that's an even number. You can see there's some price resistance here. If you're just looking for a quick in and out bounce target, but it could get some legs, because like I said, a lot of things hit the big support level. So if this support level holds on a daily closing basis, which again is this level here, like 449.70, we hit the fib in there. We could bounce all the way back up to where we were the other day. It could be a much larger bounce. Remember, we just dropped in 2 days. We dropped 6.5%. That was a golden shorting op yesterday, especially for trend swing traders. We could go back there, but let's just play it one day at a time, because we haven't even reversed yet. So let's see if we can bounce. The trend line is going to be a first big resistance, a back test of the trend line, and like I said, just looking for that. I'm looking for that little kind of relief rally that the Fed rate's locked in. Let them buy it up, and then do the same thing we did yesterday. Turn around and short into that euphoria, when the time is right. Otherwise, we go down a little bit more. Like I said, the downside from today's low is minimal to the next good support level, the 200-day moving averages, and that 431.80-ish price level. That's only about 2.7% below today's lows. So that kind of quantifies what I think is the most probable or likely downside if we don't bounce first. And if we happen to shoot through them on a meltdown type thing, then you have that previous T2 that's at 413. I should probably round that off, but that's going to be, when that target's hit, that's about a 7% drop. Okay, but I doubt we're going to go through the 200s without any kind of buying programs firing off, because there's price support there too. All right, I'm going to wrap it up here, get the video out to you, because we're still flirting with the lows of the day, and let you guys decide how you want to play it. This has been Randy Finney with Right Side of the Chart. Have a great day.